I'd love to just get your sense of what you think about market structure and whether or not it's truly changed over the last week or so.
Yeah, look, this is part of a long trend towards the democratization of investing, starting with the early pioneers like E-Trade and Ameritrade that brought stock trading prices down from a couple $100 per trade to 10 to 50. And now Robinhood kind of stands on the shoulders of those giants. But it's not just in that space of stock trading. It's also in online media. I mean, look at what CNBC or Street.com or Yahoo Finance and Motley Fool have done in terms of democratizing access to information about investing. So that long trend is continuing, will continue. I think in the case of Robinhood, and people who use it should know that if you're not paying for the product, you are the product. In that sense, it's like Google and Facebook, which is to say that they're selling your information and that's their business model. And personally, I'm okay with that, but people that use Robinhood should understand that that's how it works. I think the perspective that I can provide is what it's like to be at a company when it's heavily shorted and when the stock is incredibly volatile. And that is extremely distracting, extremely concerning. I saw Mark Cuban on last week, and I think he said something like, look, in the long run, this all kind of works itself out. Companies too high, companies too low, but in the long run, the stock price is okay. He's right about that over the long term. But employees at the companies, they live in the short term. And when your stock is incredibly volatile, partners get concerned, advertisers get concerned, legitimate shareholders, real long mutual funds and long hedge funds, they get concerned because buried in these short themes, there usually is a little kernel of truth, which the company can rebut. But sometimes these kind of rumors become, they become a narrative of their own. And it's very, very difficult for these companies to fight back.
Right. So extending on that experience you had as a CEO, where you have perhaps a higher than normal short interest, what are they thinking right now, these companies that are seeing those same shorts squeezed? Is there a bit of schadenfreude there? And also,
Definitely.
Spencer, what is the fiduciary role of those CEOs to raise money when their stock is elevated like this?
Yeah, so there's definitely schadenfreude. I mean, look, at Zillow, for example, we knew that we were always one of the most heavily shorted stocks on the NASDAQ. And, that was almost a badge of pride internally. It was like, wow, look at all those unbelievers who think we're going to fail. We're going to prove them wrong. And that's fine. I can sort of accept that. What I can't accept is when hedge funds that are short talk their book and dress it up as research and pretend that it's a research report as if it's sell-side research from a proper investment. Like, it's not. These are hedge funds that are short and they're talking their book. They're putting out rumors and innuendo, and they're just manipulating the stock prices. And that's very frustrating. And 2012 to 2014 at Zillow, we were the victim of that. And it was a very, very difficult time to be running a company when you have a short attack. Do CEOs and boards have fiduciary to sell stock or to take advantage of market conditions when the stock price is way up? I do think that companies should be opportunistic, and certainly at Zillow we did that many times when we did quick converts or quick equity follow-on offerings when the stock price was pretty elevated, and I think that's just prudent. Now, to try to do it into a really volatile market environment like GameStop is seeing now, or AMC, like, I don't know, that requires pinprick precision, and it's very difficult to pull off.
Shepard Smith here. Thanks for watching CNBC on YouTube.